expectations of very strong profitability, but investors will be waiting 3 years or so?
Our investors are telling us that they see really good sense in our expansion plan because they can see the development of this industry opportunity over the next few years and have encouraged us to invest into that as a leader in a new market.
Your share price has jumped from $8, which was the COVID low, to over $90 in the space of just a few months. How much of this is hype? Is it overdone?
Some really important structural shifts that have frankly always been present, particularly for the last 10 years, have just become enormously accelerated in the last 4 months. Those shifts is a shift online, which we're the beneficiary of. But there's also another one, which is around customers' preferences to move away from traditional credit products. You know, we found it off the back of the global financial crisis, and a consumer that doesn't want to get entrapped in, traditional debt products.
You're involved in setting up the self-regulatory code, and the draft is going to be reported on by ASIC in October. You've previously voiced opposition to credit checks for customers. What if ASIC has a different view?
Yeah, we're not against credit checks in the sense that we don't want to promote responsibility in any way, shape or form. To the contrary, I think credit checks are often positioned as being some sort of a silver bullet that goes with regulation or responsibility. It's absolutely not the case. The issue is it's not great for customers. Over half our customers, and we've got 10 million customers plus across the globe, don't have a credit file that's relevant. And when we look at the outcomes that we're generating from our system that promotes responsibility, we're actually getting lower default rates than any of the other players that actually employ these things.
Well, the Banking Royal Commission highlighted that self-regulation didn't work for the financial sector. Why would it work for the growing buy now, pay later sector?
The thrust behind a code of practice isn't to move away from any form of regulation. It's how can we do more as a new industry to illustrate that real customer advances and protections can come out of collaboration. And we think if we can bind together on that front, again, we can get back to the things that matter, the customer outcomes that matter. As you said, during Royal Commission and other things, it's shone a light on the fact that notwithstanding regulation, sometimes you don't get the right customer outcomes. From our point of view, and I believe from this new industry's point of view, it should all be about that. So regulation that's fit for purpose, but also taking on board what you can do more as an industry is the entire thrust behind the code.
Buy now, pay later stocks might be grabbing everyone's attention, but Australia's big four banks have traditionally been a safe bet in any portfolio. But with earnings in retreat and dividends slashed or cancelled altogether, can you bank on banks through the biggest economic crisis since the Great Depression? Elise Morgan spoke with banking analyst Brian Johnson.
Brian Johnson, thanks for coming in. What's your view on the economy? What's your base case scenario?
Well, Elise, you've got to remember that Australia went down into a lockdown on about the 22nd of March, and we were told to brace ourselves, we'd be locked down for 6 months. During that intervening period, we had rental eviction moratoriums, we had actual rent moratorium, we had loan repayment moratoriums, we had the JobKeeper wage subsidy, we had JobSeeker, and we came out of that lockdown effectively 6 weeks later. And so what you actually went into is you went into the most fantastic time because there's a lot of liquidity slopping around. The problem that we've actually got is with Victoria now locked down again, but with a lot of this stimulus basically to wind down significantly after September, you wouldn't call it a fiscal cliff anymore, but certainly it looks to be a very challenging environment. So we won't know how bad things are until sometime after September, but I would flag to you it looks pretty glum.
We've been through the reporting season ostensibly for the banks. How do you think they've prepared themselves for what's potentially coming, given that we've been on ice for so long?
Let's unpack that a little bit. When you have a look at the bank reporting season, I think it was spectacularly disappointing. We can see that credit growth is slow, and it's not that banks don't want to lend, it's that borrowers don't want to borrow. We can see that net interest margins are falling, and that's because of very strong levels of competition on front book housing. But we can also see the adverse impact of low interest rates. We can see customer behaviour moving from credit cards to debit, which means fees fall as well as the lower activity. So basically fee revenue is lower. The one bright spot was that financial market revenues were well up, but you'd think that's like a very short-term effect.
That's the likes of, CommSec, people trading.
Yes, yeah. So it's a very short-term PE1 type event. And then the other one is that while it'd be great to think in this slowing revenue environment we can take out costs, banks seem to be giving a lot of their more lowly paid staff 3% pay rises, add in sticky regulation, and we're talking about high operating costs. Now you add all of that up, and that basically spells a challenging revenue and cost environment going forward. But then the final thing is that in August the RBA came out and restated their economic base case, and it doesn't look to me as though the banks have actually incorporated that into their provisions, which means we've probably got more provisioning charges actually going forward. So you add all of that up and it looks down, is the way I would flag it.
The CEOs reckon they've provisioned enough. They reckon that they've put enough money aside. You don't believe that?
No, I don't. At least when we actually have a look at it, if you think about the exposure at default, ANZ has got 0.47% provisioning for every $100 of home loans. The other banks are all around 60 basis points. If we take the downside scenarios that were published last time around, it says 80. Even that implies a loan loss cycle probably not much worse than the global financial crisis in 2008, 2009. But if we were to look back to 1992, the last time we had a recession, we're talking about loan losses that are significantly high on that. So as I say to my clients, you choose which scenario you believe. If you believe there's a V-shaped economic recovery, good luck. I think you're being incredibly optimistic, but you'd probably be buying everything. If you think there's an 18-month U, which is my scenario, then you wouldn't be buying. If you looked at one, it'd probably be NAB. But if you think there's an L-shaped recession risk, and I've got to tell you that seems to be the growing risk by the day without even more government stimulus, then you would not be buying an Australian bank yet. The real danger is in the stock market at the moment. It's being increasingly driven by this Robin Hood or this retail investor, which looks backwards rather than forwards. And I think that's a little bit of a danger in the equity markets at the moment.
When will the pain start for the bank?
We're really not talking about a problem that will merge until something like June to September of 2021. We're extending basically the problem. In banking, you'll often hear the term extend and pretend, and that's kind of what it looks like at the moment.
Given all of this, if you are someone who relies on dividends, should you stay in bank stocks?
Commonwealth Bank is a very big, profitable bank that tends to be held by retail investors, but we can already see they've sliced the dividend from $2 to $1. I think that's probably about the level that you should expect going forward. With a 4% and a bit dividend yield, that sounds great, but I can think of lots of places in the market where you can get that. Capital generation for ANZ is weak, which means I think it'll be challenging to actually exceed that quite trifling dividend we actually get. In Westpac's case, Westpac actually cancelled the dividend, and I think Westpac have got a number of capital problems going forward, including potentially a higher AUSTRAC fine. If you're going to have a bad year, you may as well make it a shocking year. I think it's quite plausible perhaps that you don't see a dividend from Westpac this year. But NAB and CBA, kind of the order of magnitude that we saw at the first half is probably achievable again.
Do you think they're good value, or should we wait until we do see another decline?
Well, Elise, when I go back and have a look at them, the banks were sold down in April and May. The market rebounded quite sharply in May. The banks didn't run until June, and then it was retail investors basically buying them. But as long as you've got EPS expectations are declining, the risk of dividend, all of these risks, it wouldn't surprise me if you saw them track back down to the lows that they were. That said, most of them, with the one exception being Commonwealth Bank, Australia's greatest bank, the others are all down about 25% year to date. I think they could actually go a little bit lower.
And you can see an extended version of that interview on the business website. Some are tipping capital city house prices to keep falling for at least another 18 months. But the threat to prices in the city could have a silver lining for regional properties. Working from home is making country living viable and tempting, and that's pushing up values. Amelia Terzon reports.
In the middle of Melbourne's lockdown, Ali Bonnet is packing up her life. Before COVID, she was based in the city, but the company she works for has gone permanently remote.
I've really just wanted to embrace the situation we're in with COVID and move to Daylesford, which is the most special little town in the world.
The 33-year-old bought her first house in the regional Victorian town in May.
I wouldn't have had the confidence to do this before COVID.
The pandemic triggered a flood of inquiries from Melburnians to regional real estate agents, like this one in Daylesford.
It's been absolutely counterintuitive. In the last 12 months, we've had about an 8 to 10% rise in capital value.
And it's a similar story right across the country. Brisbane's down slightly, while the Gold Coast and Sunshine Coast are holding up. Sydney homes have lost value, while Newcastle and Illawarra are slightly better. And Melbourne is down 2.3%, while Geelong is up and Ballarat is doing nicely. CoreLogic says it's too early to tell if regional housing markets are booming off the pandemic, but that there's obviously a silver lining for country Australia.
Long term, I think the strange upsides of COVID is that they've normalised remote work. People are potentially more wary of high density city areas. And that means in the long term, regional dwelling markets will see, I think, a benefit from that.
I definitely can't wait to get the hell out of here.
A population that's moving with the times.
Amelia Terzon reporting. And that's all from Close of Business. For more on those stories, go to our website and catch The Business Monday to Thursday evenings at 8:45 Eastern on the ABC News channel and after the late news on ABC TV, as well as anytime on iView. I'm Rachel Papazzoni. Thanks for watching.
Dear humans, we need to talk. There's pollution in my air and plastic in my oceans. My trees and animals are disappearing and my temperature is rising. My climate is changing. I think I can fix it, but I can't fix it on my own. Small changes can have a big impact, and right now we need to take care of each other. Signed, Your Planet.
A season of stories exploring our environment. Your Planet on ABC.
It's not just a boom, it's a frenzy.
In 5 years, it's going to be an even different world that we'll look at.
The dawn of a new space age.
There'll be millions of people living off the planet. Everything is going to be space.
And who will control it?
It is a resource race, first and best dressed.
Space is contested. It's a warfighting domain.
This is a pivotal moment for us.
3, 2, 1.
Is the future Star Wars or Star Trek?
Four Corners, Monday, 8:30, ABC and iView.
Economic growth family had never lost live performance.
This is DW.